Welcome back to Smart Money on CNBC-TV18. Our special series, Outstanding Women in Finance, is what we have kick-started this week. And we have Swati Kulkarni of UTI Mutual Fund, who's been in the mutual fund industry for 30 years now. So a great career. She's talking to us about her style of investing and how you should pick high-growth stocks that have a competitive franchise in order to build long-term wealth in your portfolio. Swati, you were telling us before the break about a competitive franchise, about high growth, but you also look at dividend yield investing. Can you explain a little bit about that to us? Because dividend yield stocks have done very well, but for the uninformed, how do I get into it now?
Yeah, so I think when it comes to investing under dividend yield investing style, what is also important is that not just the current dividend yield, but the sustainability of those dividends and also the capital appreciation potential of the company that you are going to invest in. So if you want to have some visibility around this, what is important is that the free cash flow that the company has been generating, the free cash flow yield should be higher than the dividend yield. And also the profit growth should be there to kind of see an increasing dividend receipts even if the dividend payout ratio remains same. And our studies of the Nifty 500 companies, if you see on a last 5-year basis, we have seen that out of the 144 companies, if you apply both these filters, actually the 38 companies qualify for this, and the return increases, average return increases from 15% from this 144 companies to about 24% for the 38 companies which have both higher free cash flow yield than the dividend yield and an earnings growth of about 12% in the last 5 years. So I think that is what is very important, both free cash flow generation, sustenance of dividend, and the capital appreciation potential.
Okay, so that's on dividend yield companies. But, just giving us a bit of a bird's eye view on your investment journey, right? I'm sure there are a lot of mistakes that you have made as well in your 3-decade-long career in your own personal investments. So for the viewer who's watching you right now, if you had to identify 1 or 2 investment mistakes that you made that perhaps others should avoid or can learn from, what would they be?
Yeah, so I think one clear mistake that I remember, and that's like I have decided not to go that path, is like in 2000 I was quite the exciting opportunity that I thought was in the media space. That was a company into special effects, animation, and there was a lot of option value that the we were building much higher than the actual business that the company was running at that point of time. And so that's one thing which I would say that I would avoid forever, that giving too much of option value and having a lot of hopes around this. On a personal front, I would say, Sonia, that I as a young investor on a fund manager, I thought I could time the markets better, and I regret that I did not invest at when the markets corrected in 2000 from 6,000 levels to 2,800. What is important at 60,000 of Sensex is not at what level I invested. Even if I had invested at 6,000, that is a 10 times return. So the quantum is more important, and that is on a personal side, I would say that's a great learning. And of course, at that point of time, SIPs were not in fashion. So maybe if that was the case, I would have started to save little early, which is a part of advice nowadays we give without actually practicing it, but more from realizing it later.
Okay, that's some pearls of wisdom, right? But just one point on that mistake to avoid. You said that there are concept stocks, there are, stock trending stocks, maybe that you should avoid. So what do you do? How do you decide? Because there are some phases which pan out really well for sectors. Defense, for example, has been a theme that has worked out for a while now. But how do you differentiate between just a passing fad, a trend, and something that's long-term?
So I get some of the things that, just the addressing the market size opportunity, or analyzing what is going to be the market for such businesses, and if at all the companies have a strong potential. For example, I can give you a telecom stock example. When this came up in 2005, 2006, the mobile telephony, there was a clear argument about the under penetration. We hardly had a few percentage points. The tariffs were going down, and therefore the adoption of mobile handset was a clear case that we could build in. So I think if you could, so at that point of perhaps that the existing business wasn't that great, but there was a solid runway for growth, and the penetration levels were so low, and that is what something you can differentiate even today in the new age businesses. And you could be looking at these businesses if there are solid, the market size opportunity is quite good, and the companies have right to win there.
Okay, and finally, before we end the discussion, Swati, wanted to understand from you, there are a lot of young people who perhaps are looking to get into this industry. You were mentioning that a lot of young women have entered the mutual fund industry as well. What is your advice to the young investor watching you right now, perhaps someone who has to start their investment journey, or maybe even get into the mutual fund space as a career?
Yeah, so I think first of all, it is important to realize that wealth creation is a marathon, not the sprint, and therefore it is important to avoid unnecessary trading. And I would like to also say that it is it's also important that you avoid the value destructors early enough. Secondly, I would say that allow the compounding to play out, and I would quote that recently I saw that almost about more than 85% of the wealth that Mr. Buffett had generated is after the age of 65, and he started investing when he was in teens. So allow the time to fructify the good businesses that you would have spotted, and typically high ROC cash flow generating machines, if you happen to spot them, it's better to kind of hold on to them. And again, I'll quote Charlie Munger's quote here, which I like, and my investment style has got influenced by that quote, is that buying great businesses at fair price is going to be superior than buying fair businesses at cheap price. So that is one thing. And for professional fund managers, I think it is very important that integrity is given in this business. It's a business run on the trust. Retail money is what you are managing, and always remember that your reputation is invaluable. So I think that is something which is very important. And while we construct a portfolio, I think position sizing and knowing that there can be something unknown which might hit, and preparing for that risk is also very important when you are building your portfolio. Don't assume that the past risks are going to be a good future guide. Market and the environment always has some risk which would be totally unexpected, and it could turn out to be a nasty surprise. So I would say these things would sum up, and you would do good if you kind of take some lessons from my learnings, Sonia.
All right. What stays with me is you saying that wealth creation is a marathon and not a sprint, right? You need to give it time. Swati, pleasure speaking to you. Thanks a lot for joining us in our Outstanding Women series, and hope you continue to do the good work for many, many more decades and continue to bring returns to your shareholders and create wealth for them. Thanks a lot for joining us on Smart Money.
Thank you, Sonia. My pleasure.
Okay, with that, it's a wrap on this special edition. This is a series that we've kickstarted, Outstanding Women in Finance. So if you know any outstanding women in the world of finance, be it mutual funds, brokers, entrepreneurs, just write into us and we would love to feature them on the show. Thanks a lot for watching.